The coming hyperinflation of Australian property. Martin North, John Adams, in the interest of people. Hello, John.
Hello, sir.
Well, we're back in the studio again, and guess what? Our favourite subject.
Yes. Well, we're going back to where we first started, which was debt, interest rates, property prices, and where's the direction in terms of where we go here. I'm sure you'll attest to this, Martin, that in the last few weeks, we've already started to see a whole sea change in the psychology of Australians across the economy, but also globally. Markets are crashing, cryptocurrencies, shares, commodities are going down quite heavily. A lot of concerns. Even I'm picking up anecdotally, people are talking about interest rate repayments in terms of mortgages. And so people are saying, do we fix? Do we, what are we doing? How do we manage if the RBA continues to increase interest rates? And obviously there's a concern about property prices as well, and a lot of speculation as to where property prices may or may not go. So basically, we have a couple of episodes before we talked about stagflation and how this sharp rise in official inflation released by the Australian Bureau of Statistics is hurting a lot of Australians at the moment. That's why you've got elevated mortgage stress in your data set. And so now I think it's time that we talk about where do we think things are going to go. Now, if we can cast our mind back to 2020, I made a big claim about where I thought property prices would go. And we did a show called back on the 19th of June 2020, house prices are unlikely to collapse in the next 18 months. So let's actually play a key clip from that show.
I know people have taken specific financial decisions resulting from the debt thesis about a severe crash in house prices. And what I would like to communicate to the audience is that on the evidence that I can see so far, I don't see that happening in the next 18 months.
Right, bold claim. But the fact of the matter is it's very hard to know, isn't it? That's why scenarios are quite useful. But there are some factors to take account as to why it is that perhaps the debt bubble is going to go on for a bit longer, right? And if the debt bubble goes on for longer and doesn't explode, then effectively the downward forces on house prices are less.
Indeed.
Yep, and at the time, I think I said it's a big call.
Yes.
Because that was really much zigging when everybody else was zagging, right?
Yes.
But actually, you've been spot on.
Exactly. So I was pretty confident that once they said Q into infinity of March of 2020, and that they were going to put a floor on the market, basically they're going to save the debt bubble and property prices were going to stabilize and not collapse. And obviously Harry Dent and a whole bunch of deflationists were saying it's going to be a full-on collapse. Well, not only did it not collapse, it went through the roof. And to be honest, I was a little bit surprised that in such an uncertain environment with lockdowns and all these control measures with the pandemic, that a lot of people were willing to commit themselves to quite significant mortgages. But speaking to local real estate agents here in Wollongong, the FOMO phenomena, a lot of real estate agents, they said that was actually real, and people jumped on because they thought if we don't jump on now, we're going to miss our opportunity to enter the property market. So I know some analysts like to talk about FOMO, but some people like to hype it up. But real estate agents were saying that particularly in the second half of calendar year 2021, it was real, particularly here in the Illawarra.
Well, you can put a whole bunch of factors in. Rates went much lower than I expected they were going to do because the Reserve Bank was really silly and took rates way too low. But we also had the government stimulus programs, right? We had the home builder and we had the new first-time buyer schemes and all those things. And then we had Michael Zucker and others basically spruiking property as the only way to go. I remember him several times giving financial advice to people. So, it was wall to wall. Property is where you should be. So maybe it's not too surprising that people followed it and therefore prices went very high. And of course, prices spiked very high here and also in New Zealand. In New Zealand, of course, now it's all going into reverse.
Indeed. So whereas some people have questioned our ability to forecast the economy, and as well as financial markets, at least we can give Adams a tick because he got 2020 and 2021 correct. So now, where do I think we're going in 2022 through to 2024?
Yeah,
now,
good question.
Now, obviously, we're in May now, and everyone's talking about interest rates and inflation, etc. But I actually wrote an article at the beginning of February for my website, and let's actually put that on the screen. And it's the same title as the title of the show, The Coming Hyperinflation of Australian Property. So I'm not a Johnny come lately. I put my position well down about 3 to 4 months ago, and people can go have a look at, because there's a lot of detail that I put into that article in terms of what I think is going to happen. But in essence, what I think we're going to see is, so obviously we have sharp inflation. Obviously, part of it is due to the stimulus package of the last 2 years. Part of it is due to the Ukraine and oil prices, and we're starting to see rates go up. Now, we've had a whole host of financial institutions like ANZ and Goldman Sachs that are now saying we're going to have 8 consecutive rate rises between May and December of this year, and we're going to some sort of neutral rate of 2.5%, which is what the RBA governor has suggested. Now, my view is that there's a mathematical limit to how high interest rates can go, and that is because of how indebted the Australian economy is. Households, business, and government, but particularly households. So here's my general process of what I think will happen is interest rates will go up. We'll see a sharp decline in asset prices, which we are now. We'll see a sharp decline in consumption because people are less able to purchase because of interest rate costs going up. We'll see a decline in consumer and business confidence. All of that will translate over the next few months into lower economic growth and potentially rising unemployment, given that we have very low unemployment at the moment. And then when that happens, obviously that process will play out for a while. Then we'll start to get questions about what the ability of households will be to make their debt repayments to the banks. So I think we'll see elevated mortgage stress levels in your data set beyond the 42% that we're at the moment. Then we'll see a sharp rise in problems paying back the banks, delinquencies, etc. The banks will obviously start to get nervous about critical mass of if there are too many borrowers who are now in some sort of financial peril. Then the RBA and the other central banks will pause, waiting to assess, what sort of financial stability we have in the country. And then once they realise that the economy is too weak to sustain higher amounts of interest rates, that's when they're going to start cutting again. And then when we get into the new monetary easing cycle, I think the amount of additional stimulus that's coming, which is likely to be next year going into 2024, will be a magnitude bigger than what we saw in 2020 and 2021. And the reason why I think the stimulus will be larger is because anytime you have a growing debt bubble, to keep it going, you have to pump it with ever more amounts of stimulus to keep it intact and to keep the show on the road.
Yeah, and that's really important to understand, isn't it? Because it's not just a linear thing. You actually have to push more and more into the market to be able to get the same effect again. I mean, the research was done some years ago suggested that really you probably need a rate of -3 or 4% to get the same sort of stimulus as you got a decade ago, because the debt is so much bigger and the rates are so much lower to start with.
Yes.
So presumably that means negative interest rates.
Well, we will get to the issue of negative interest rates because I think a lot of our viewers have missed the boat about what really the government was doing. While everyone's focused about COVID, there was things happening in the background on negative interest rates. But before we get to there, I just want to bring this concept of the neutral rate, which is something that both the RBA and the US Federal Reserve has been talking about. So in the economic literature, the neutral rate is the rate in which you set the official interest rate where the economy is neither contracting nor is it growing. And so Philip Lowe, the governor of the RBA, has said for Australia that's about 2.5%, and for the US Federal Reserve, they've said it's just above 3%, maybe 3.25%. Now, the key thing to my mind, and mathematically trained, is that the debt in over 2020 and 2021 has grown substantially compared to where we were in 2019. Now, in 2019, the official cash rate in Australia was 1.5%, and in the US, it was 2.25%. And so the question that becomes is, if the debt is so much larger in 2022 compared to 2019, is it reasonable to assume, could we go back to where we were in 2019, or even what the RBA governor and the US Federal Reserve chairman are saying, can we go beyond where we were in 2019? And would those higher levels of interest rates be sustainable in terms of financial conditions? I mean, only in the last few weeks did the US Federal Reserve chairman say that we will tighten monetary policy, raise interest rates, subject to economic and financial conditions. And so they always have a caveat.
Get out.
Yes, so the caveat is always data dependency and also financial stability. And obviously, as you raise rates with the biggest debt bubble in the history of the world, if things become unstable, well, they've already told people, if you understand how they talk and read between the lines, that instability is the mechanism which they'll stop raising rates and they'll reverse course.
Absolutely. And in fact, you're already seeing some signs of instability at the margin. So we know that liquidity in the financial system has been drained quite significantly at the moment. That's one of the reasons why bonds are doing what they're doing. And the financial stability report that came out from the Fed last week called out specifically some concerns that they had about the financial stability within the system. And they mentioned, of course, the war in Ukraine and those sorts of things. But the most interesting thing is this commentary about the lack of liquidity and the fact that that's a really significant factor. So they're already signaling they're concerned about that. And it's interesting that we've had a financial stability report from the New Zealand Central Bank and Australia too. And basically they're all beginning to say, there are a few signs that stability is going to be an issue.
Indeed. Now, the really interesting point about stability in the Australian context, Martin, is to what extent are our banks, particularly the big four, exposed to property, but also exposed to the household sector. Now, in previous shows, we've given a rough international benchmark that our international banks or foreign banks usually lend at about 38% of their total debt portfolio into mortgages. Now, I created a data set for my article, and so let's just put this on the screen. So at November 2021, at that point, it was a record high in terms of the percentage of bank lending to persons, which was about 58, 59%.
Yep.
So my key thesis as to why the RBA is even more limited than other central banks is because the banks in this country have basically put all the chips on the table and made one big bet, which is households. And so if household consumption was to collapse, if incomes were to fall dramatically, if the property sector was to tank, what that would mean ultimately is that the banks would go because they are so concentrated in terms of their position. And so this relationship between household debt in banks, the commercial banks, is so interlinked that you cannot separate them. So you can't say we're going to allow the property market to fall. In some cases, some people have said 25, 30% over the next short period of time, and that's going to have little to no impact on the banks. It's going to have a huge impact. And so that's why I think this particular phenomena is a bigger issue in Australia compared to other economies.
I agree with that because, of course, we've got the most extreme debt footprint almost any economy with regard to the household segment. The mortgage lending that we've been through in the last cycle is massive. A lot of people have very big debts, but they also have lots of other things like the buy now, pay later sector, which is not counted in any of the official statistics, by the way, but it's still a big number. So wherever you look, there's wall-to-wall debt. And it's interesting how the banks have come out through this last reporting round and saying everything's fine, households doing well, they've got all the buffers. But as we've discussed previously, not everybody's got buffers. There are some who've done very well and have got money in the bank, and thanks to the stimulus programs and things like that. But there's a lot of other people, according to my data, that have nothing. They're really hand to mouth. And with the costs of living going up and the revenue from income not going up, and now mortgage rates going up, it's a really horrible pincer movement. And so that's what I think is going to play out. And as you're right, there's going to be a point at which they've got to say, hang on, we can't do any more of this.
Yes. Look, one question that I would have for you, Martin, and I'm fascinated in your understanding is that for those that have buffers, and obviously different households have a different level of buffers, as rates start to go up, as inflation starts to, or like in terms of bite, in terms of cost of living, how much of these buffers will quickly evaporate because they have to draw on those buffers to make ends meet?
Well, there's a couple of ways around to look at it. The first is some people have already paid ahead on their mortgage. So, they've paid more than they need to, so that they're actually ahead at the bank. Mm-hmm. And on average, those with buffers are probably a year to 18 months ahead on their repayments. So they could actually afford to go through quite a long period when they were actually paying a lot lower and still actually being okay with their mortgage repayments. The reason they were paying ahead was because they wanted to get the debt down. Right? Some of them also are on these facilities where you can pull the money out again if you need to. Yes. So it's an offset account. And that's another thing that people talk about quite a lot. Well, they're in offset accounts, which means, of course, that the value of the debt's gone down, but that means they can pull it out again. And what I'm seeing already is some people who've got those offset facilities now starting to pull money out to cover the other costs of ongoing living. So it depends. There are people who can do really well, but there are other people who've probably got 2 to 3 to 4 months of buffer before they've got difficulty. And then there are other people, again, who are sitting on really big pools of savings. They may be pulled money out of super. They may be, have sold a property or something, so they're sitting on a lot too. So it's a real distribution curve. Right?
Yes.
And so there are some that will be fine for years. There'll be some who will be fine for months, and there'll be some who will fall over almost immediately. What I'm concerned about is all of those who have no real support at all.
But the key point I just want to draw out here is that those people across that distribution curve, that curve is not static.
No.
So as we move forward,
it's moving down.
Those some people with buffers.
Yep.
So for example, when I did have a mortgage, I did have a redraw facility, and there were times where I took money, additional repayments off the mortgage to cover other things. But I'm assuming that if things start to get worse, particularly with rising rates, you'll start to see more of that drawing down, and those buffers will, in some cases, evaporate quite sharply. So
well, yes, and the other point is that some people will then pull more equity out of the property.
Yes,
right.
Although it'll be difficult as property prices fall.
Exactly, but that's what people have been doing. The Equity Mate stimulus program is actually a lot bigger than the government stimulus program. If you look back over the last 18 months or so, a lot of people pulled out equity from the value of their property going up versus their mortgage.
Yes.
So that's the other factor that, again, people haven't factored into the story. So there's an Equity Mate story there. But you're right, that will soon dissipate. If properties drop 20%, a lot of equity disappears.
Indeed. Now, the one of the people that I will sort of just quote is that the Financial Review only last week quoted Macquarie Bank's global strategist, macro strategist, who also said exactly what I'm saying. He says that rates will go up, and then next year rates will come back down, and quantitative easing will start. So let's actually put that article up on the screen. But also there is a quite famed analyst who works for Credit Suisse, who used to work at the US Federal Reserve, called Zoltan Polzar. Yep. And he has also said in the last week they'll have to recommence stimulus quite soon. And the obvious reason why is that the financial system with this level of debt, it just cannot sustain. It's kind of like a drug addict, and you take the drugs away, you take the heroin away. Well, you go through really bad issues when you have withdrawals. Well, look, some people can survive physically by going through withdrawals of narcotics, but unfortunately, the financial system can't go through a withdrawal by having no stimulus, because as we've seen throughout human history, that the debt bubble will collapse. Now, we come to, I think, a really important topic, which is these negative nominal interest rates. Now, if our audience casts back to late 2019, the the RBA governor gave a key speech in Sydney and said on this topic, and said unlikely, even though in 2019 we kept on saying on this show negative interest rates are coming. Yep. He said we've looked at it, doesn't work, unlikely, perish the thought, not going to happen here in Australia. Well, while everyone was deeply focused on COVID-19 last year, what was APRA doing? APRA was getting the banks ready for negative interest rates. So we'll show two press releases published by APRA. So in July of 2021, they initiated a consultation around the introduction of negative nominal interest rates, and for the banks to be ready for that. And basically they said, well, what we want the banks to do is to develop what they call so-called tactical solutions that can handle negative interest rates. And what that would mean in practice is that the IT systems of banks are usually programmed to deal with positive numbers, not negative numbers. So you would think it's a relatively straightforward thing. So in some software packages, it's not so straightforward. But also, banks have a variety of different saving and debt products, and so those products have to be prepared if they have to price in terms of negative interest rates, but also in terms of how the commercial banks deal with the RBA and their reserves. If there was a negative interest rate, how does that relationship happen? So basically, rather than just implement it and just say, that it's all going to work quite smoothly, there is a bit of preparation that APRA is trying to install. So that's where, in July of last year, APRA drafted or released their draft expectations, had a consultation round. So by October last year, on the 20th of October, they drafted their final set of expectations. And what they said was that by the end of July of this year, the development of these tactical solutions must be completed, and that 3 months after that, which is the end of October 2022, they must be in a position to be fully implementable. So that's what is actually has been happening since maybe about 10 months ago, yep. And will continue on for the next 6 months. And you think to yourself, when in the middle of a pandemic, everyone's focused on public health. We're seeing stagflation in 2021 in the United States, and now inflation's here. So in that whole environment, why is APRA saying to the banks, get ready for negative interest rates? And so for me, I think APRA let the cat out of the bag as to what is coming. And that's why they're preparing Australia's financial institutions for the next round of stimulus, which will be bigger and which will involve negative nominal interest rates. So before I talk about the implications of that, any comments?
Yeah, a couple. Yes, I think that's absolutely right. And of course, in some areas of Europe, negative interest rates still exist now. But the other point is the tactical solutions they're talking about means not necessarily having to make major changes to systems. They could, for example, on deposit accounts, just put a fee on the deposit account rather than actually directly correlate it to a movement in interest rates, right? So There are tactical ways that the banks are actually looking at the moment to be able to effectively charge people for holding deposits at the bank, firstly. And secondly, of course, the other question is, how does the work when negative interest rates are such that effectively the RBA then hands money to the banks for them to lend on, which is precisely the model that's been going on in Europe through the Eurozone, thanks to the ECB, for quite some time. So actually in Europe, what's happening there is that the profitability of the banks are directly being supported by the rates being sent through from the ECB. And that's another negative interest rate scenario. So those are some of the things that are being pulled apart here. And you're right, it's preparing the ground for lower interest rates and negative interest rates. And as you say, if rates are really going to go up, and everyone was thinking about that, why are they thinking about this? Because some people are aware that things may have to turn quickly.
Yes. And just to explain, Martin, for our audience as to what is negative nominal interest rate. So only in the last week, we saw this announcement about interest rates being charged on balances at the RBA. So basically, there's each commercial bank has a bank account effectively with the RBA. They put reserves in there. For the last couple of years, that interest rate has been zero on those balances. Last week, they announced that the RBA is going to actually start paying interest to the commercial banks. So that actually provides an incentive for the commercial banks to park some money at the RBA because they actually can generate some return from that. Yep. Now, what happens with negative interest rates is that basically the RBA effectively is charging commercial banks, an interest rate or a fee or whatever you want to classify it as for leaving money at the RBA in these reserves. And what the RBA is trying to do is say to the banks, take these reserves, put them on your balance sheet, and go lend them out. And by lending more and more money out, basically that gives banks with more liquidity to drive interest rates down in terms of commercial interest rates. And so that's why if we think about what people were borrowing last year in terms of mortgages, so having spoken to a number of mortgage brokers, a lot of people were able to sign up new mortgages or refinancing at about 1.8, 1.9%. Obviously some were lower. There were some higher around the 2.1, 2.2, but a lot of people are about 1.8, 1.9%. And so in a nominal negative interest rate environment, what I'm anticipating is that we're going to see mortgage rates potentially go down to about 1% or potentially lower. Now, what does that mean? It means that from 2% or 1.9 down to 1%, you've effectively cut the interest rate at half. And so one of the comments that you made in a show that we did last year is that Australians don't care about paying back the mortgage. When they make the decision to sign the contract, it is, can I repay the mortgage now? And so
the servicing of the mortgage.
Yes.
Yeah, the servicing is the critical thing, not repaying the capital.
Yeah, but it's a servicing today.
Yeah, correct.
Can I service it today? Yep. So if mortgage rates were going to go to 1%, that would mean that on a cash flow basis, households can borrow a substantially larger amount of money compared to what they were borrowing in 2021. And so if that was to happen, where would a lot of that additional new borrowing go? It would go into property. Yep. And that would drive property prices substantially higher compared to where we are today, even though a lot of people have said that property prices was completely unsustainable and bonkers in 2021. In this scenario, property prices would even go to a much more elevated level. And so that's what I think the direction of house prices will go. Now, even though to some degree, Martin, I own my own home outright, I have no debt, and you're the same. So for us, this is in some ways a theoretical conversation because we have sort of settled positions financially. But for a lot of Australians, it's a very real and tangible conversation that we're having today because their decisions and their forecast, their expectations on inflation, negative interest rates, and house prices is potentially going to impact how they live their lives and what quality of life they're going to have over the next 2 to 3 years. So there will be obviously some people concerned about house prices crashing. There probably have already been people who have sold out expecting house prices to fall quite sharply and they can buy a cheaper property. And obviously, while in 2020 I made the right call in terms of house prices won't collapse, in theory there's a chance I could get this forecast wrong. But the question that our viewers have to ask, particularly those who are making real-time financial decisions, this is not economics. At the end of the day, this is politics. And so the one thing that I would say is that the elite power structure in this country, but also globally, do not want to lose their power. And so if they raise interest rates too high, if we had financial instability, if we had a financial crisis in an economic depression, what would that mean? It would mean that the banks would go bust, and all of that commercial financial power that a number of people hold would be dissipated. The bureaucrats would lose all their credibility. The politicians would be voted out because they've triggered a depression. And all the current crop of elites would basically be swept away in that depression. And obviously it would create a new environment for a whole bunch of new people to emerge as the new leadership of the country, both in corporate world, bureaucracy, in terms of politics as well. And so now a lot of people have said to me in Parliament, and I remember confronting my old boss about this, about popping the bubble, having a deflationary depression, and actually establishing the economy on a sustainable footing. I've been told straight out, you cannot win elections that way. We would lose office if we attempted to do that. So there is a conscious effort to keep the bubble going. And so that's why I'm confident in this forecast, because our elites are not suicidal, they're not kamikaze, they're not going to do something stupid. And only in late March did I think the assistant governor, Chris Kent, told Senator Rennick, we have no conscious plan to crash the economy. And so that's why I think as people make their decisions and set their expectations between now and the end of the year, particularly as people are concerned about rising interest rates, think about what do the powers that be, what do they want? And if anyone thinks so on this question, if anyone thinks there's a choice on election day in a week's time, there is no choice. Even last weekend when Albanese and Morrison had their leaders debate on Channel 9, the first question was about inflation. None of them talked about the RBA or money printing or in terms of the expansion of credit versus the banking system. They all talked about using taxpayers' dollars to provide some sort of immediate short-term assistance around key areas of concern like petrol prices or childcare, etc. But no one is willing to address the elephant in the room, because they know that the consequences of that is too extreme politically to handle. So that's why I think we're going to see a new cycle of easing, probably starting in 2023. We're going to see negative interest rates probably by 2024. Mortgage rates will be lower than when they were in 2021, and property prices are going to go sky high. And that has a whole host of implications for millions of people, both in property, but also people who want to get into property over the next couple of years. And people need to, I guess, listen to us or make their own assessment, and then obviously find out who is most accurate, and then make your financial decisions accordingly.
Yeah, and just a couple of add-ons. Firstly, of course, that stimulus program will also have a significant upside impact on the stock markets too, right? Just like it did the last cycle. So what we'd be doing is playing the last 2 or 3 years again, right? Which means more asset inflation, the devaluation of real money and all of that sort of stuff. It's all part of that program. The second is that sometimes it's worth just reflecting on, at the RBA, they have this model, right? And this model that they've got shows that for 100 basis point movement in interest rates, property prices go up 30% or down 30%, right? So if you're right, if rates drop back down again and stay down, property prices might go up another 30% from where they currently are. And that's a pretty scary thought for many people, because many people would say, well, hang on a moment, they're already really sky high. But people need to understand that property prices are absolutely connected to the free flow of credit and the price of credit. And when credit is expanded and the price of credit drops, property prices go up as sure as eggs are eggs.
The other key point to notice is that property prices, in my assessment, is critical to financial stability.
Yep.
Because obviously, if banks are lending out at a particular valuation, if those property prices were to fall, it has a material impact on the bank's balance sheet, and that has serious concerns. So it is about the movement of credit. Property prices are a big thing in terms of the bank's balance sheets, and so as we move forward, you're going to start to see more banks squealing about rates being too high, and we need to stop and reverse.
Absolutely, and expect more lending standards to be released and all of those things. We're just going around the cycle once again, aren't we?
Absolutely.
John, thanks for your time today. Very important conversation this, and we'll check back in another 18 months to see whether you were right again or not.
We will see.
Thanks. Martin North, John Adams, In the Interest of People. We'll see you next time.